Hello and welcome, listeners, to our first episode of the Opal Group webinar series, Finding Safe Opportunistic Investments in Times of Turmoil. It is featuring and sponsored by Spurs Capital. The topic of today's episode is the impact of U.S. government intervention on mortgage servicing and real estate capital markets. A little background on Spurs Capital. They are a New York-based investment firm focused on investing and managing of distressed mortgage loans. They provide competitive solutions to financial institutions seeking to increase revenue, increase profitability, and decrease earning volatility and manage risk. Please be sure to visit Spurs Capital's website to learn a little bit more what they can do for you and your organization. Feel free to go directly to their website at spurscapital.com or go to the Opal Group website at opalgroup.net to gather more information on them. If at any point in today's episode you have any questions, please make sure you type those into the Q&A box on your screen. Please ask your questions as they arise, and the presenters will do their best to answer all of them. And as a reminder, a copy of today's webinar will be made available on Opal Group's website under the On Demand tab. And I would like to remind everyone that episode 2 of the webinar series will take place on September 15th, and we'll be focusing on rising defaults, that create opportunity for distressed debt buyers. We do have a great program lined up for everyone, and we'll have, Kai Tsukiyama, Vice President, Portfolio Manager of Spurs Capital, and we'll also have Harris Howard, attorney over at the Howard Law Group, join us and speak to the topic in a little bit. But first off, I'd like to introduce to you our main presenter, Bill Bymel. He is a managing director at Spurs Capital, an investment management firm focusing on distressed mortgage loans and real estate. Like I said, as vice president, Bill built an asset management team responsible for $1 billion in equity investments. With 18 years of retail experience, Bill is known as a pioneer in the distressed residential mortgage investments space by creating a new paradigm for managing delinquent borrowers. His strategies and experience overseeing the resolution of hundreds of millions of NPL since 2009 are illustrated in Bill's book, Win-Win Revolution, an insider's guide to investing in the secondary mortgage market. And now here, the leader of the Win-Win Revolution is Mr. Bill Bymel. Take it away whenever you're ready.
Thank you very much, Merrick. And thank you all for joining me here today. I have some exciting panelists that will be joining us shortly. We're happy to be here to update all of you on the status of capital markets, real estate, and the mortgage industry. A lot of changes have happened in our world in the last 6 months, and it's obviously having its effects on real estate and mortgage, as well as many other industries. We're going to go through the agenda right now and quickly tell you about what we're going to discuss today, and then we'll get right into it. We're doing a few introductions here this morning. I'll tell you a little bit about my background, how I got into the NPL investment world, NPL strategies. Then we will update you on what has happened to capital markets and the mortgage industry and what we're seeing month by month, starting with March of this year. As many of you saw, real estate and equity markets take a plunge, or mortgage and equity markets taking a plunge. And then we're going to open up the conversation into today's topic, which is the effects of the 2 major government interventions on our markets. I do recommend that you post your questions as we go. At the bottom of your screen, you'll see a Q&A button, as Merrick had mentioned. Please feel free to post questions at any time. We will spend the last 10 to 15 minutes answering live questions directly from the audience. So anything, whether it pertains to the mortgage market, to new originations, to older loans that are going into default, whether it pertains to residential real estate or commercial real estate. We've got some experts here today that are welcoming your questions and glad to be here to help you out. I also have, as a special feature for those who have attended live here today, the link mentioned on the screen here in npncapital.com/book. We're sending out a free copy for those that have not read or received a copy of my book, Win-Win Revolution. You can fill out the form at the link listed here on the screen. We'll also post this link in the chat, and we'll be glad to send you out a complimentary copy. That book was written about 3 years ago, and it details my experience in the NPL mortgage market over the last decade. As mentioned, my name is Bill Bymel. I'm a managing director at Spurs Capital and fund manager for a new limited partnership called First Lien Capital LP. I've been in the real estate and mortgage markets for almost 2 decades. I grew up in South Florida, graduated of NYU. I've lived in New York, Los Angeles, and Florida, with some minor stints in other parts of the country. I've been a real estate investor since 2004, so just over 15 years. Starting out as a residential fix and flip investor, got involved in some buy and hold REO rental. I've owned commercial real estate and as well as residential as well. I'm a partner in a commercial advisory firm called Retail Sites International, which is based in Fort Lauderdale, Florida. And I got into the non-performing loan investment world in 2009 when I first bought my first NPL. It all started in the summer of 2008 when I got a call from a fund manager in Southern California, opening the door for me to join a small boys club called the secondary mortgage market. The secondary mortgage market is where loans and esoteric investments in real estate and other industries are traded via a loose network of investors, accredited investors. What was key to me when I got involved in this business, though, was the paradigm by which we operate. Nobody wants to buy bad loans and become a debt collector. So for me, it was important that if I was going to get into this industry and take advantage of all the opportunities that real estate investment offered, that I do so in a way that I could sleep well at night. And that's really what's spoken about in my book. What else I loved about the secondary mortgage market and investing in mortgages and NPLs especially is when I looked at this industry, it's an esoteric investment strategy, and it's an opportunity to arbitrage real returns backed by real estate, so with very little downside risk. And the mortgage market in America alone is a massive, massive market. Residential mortgages total 10 trillion. If you add in commercial mortgages to that list, the numbers skyrocket. So at any given time in a normal market, there might be a 2 to 3% default rate. So at any given time, there's hundreds of billions of NPL sitting on the sidelines that are working their way through the system. And lenders often look to move that NPL, especially banks that are under capital reserve requirements or new originators who get pressured by their credit facilities to move non-performing paper off their books. So I knew that getting into this industry, I only needed a small, tiny fraction of market share in order to take advantage of an industry that doesn't have a ton of competition and is not that difficult, is not that easy to get access to. So when we developed our NPL strategy more than a decade ago, it was with the idea that we would create a new paradigm for operating within this industry. We have 2 factions to our strategy. One is to be a liquidity provider to banks, large funds, institutional investors, holders of paper that is non-performing. And then the flip side to that is to become more of a Robin Hood to individual borrowers, to really treat our borrowers like individuals and deal with each case on a one-by-one basis to really serve the best interest of both the borrower and us. See, the key to the NPL industry is banks and anybody who owns a loan. The minute that loan becomes non-performing, in the financial world, you have to market the value of that loan. So it really loses all, if not most of its value to an institutional investor such as a bank. Whereas you and I know when you're buying a first lien mortgage, that's not something that can be wiped away. It's a pretty safe investment. You're usually buying mortgages that are a percentage of the value of the underlying collateral. And then we're further discounting that because we're able to purchase that paper usually at about 60 cents on the dollar on average nationwide. So we utilize our boots on the ground network to get in contact with borrowers and really listen to what they need and find a way to come up with a resolution that's a win-win. The key to most mortgage servicing and most banks and debt collectors is they want to fit you into a box. There's not a lot of flexibility. So when we see those inefficiencies in mortgage servicing and we come in as private equity investors in the space, it really opens up a huge opportunity to make deals where others could not. And that's where the Robin Hood element comes in. So we're able to make our money on that spread between the purchase that we pay and price that we pay for the collateral and what that property is worth for liquidate. I will tell you that a majority of our NPL product is worked out by a means other than foreclosure. Foreclosure is our absolute last resort, and we're only doing it about 20 to 30% of the time. Many of those times is because the borrower has passed away or has somehow in their mind decided that they either want to delay or play the system, or they blame us or the bank that originated the loan. But for the majority of the loans that we purchase as non-performing at a percentage to their face value, the majority of them are worked out through refinance, through a modification. We love to keep people in their homes if they have affordability. We'll give them a fresh start, no problem. And then we love to work out alternative solutions, whether that's paying a borrower, helping set them up in a new home, or whatnot. As a reminder here today, we are not only talking about residential mortgages, but we'll also discuss the commercial market as well. And because we have experience in both arenas, although the majority of our $1 billion of equity investment in the space has been in the residential NPL. Let's take you back a few months, 5 months to March of 2020, and kind of create some perspective on where things are so that we can jump into today's topic, which is government intervention in the mortgage and real estate markets. In March 2020, many of you recall, COVID was just setting into American culture. Businesses were closing down, and the stock markets did not like it. The bond markets did not like it. The secondary market did not like it. We saw a freeze on liquidity being that fuel of money, that pipeline of money that runs through the secondary market, that allows lenders to sell packages of loans to replenish their bank accounts so that they can give new loans. And when that market goes dry, that's the kind of thing that leads to the financial crisis that we saw 12 years ago in 2008. So we saw that happening in March, and overnight we saw lenders disappearing, especially in the non-QM space, the non-qualified, non-government insured new loan originations. Mortgage lenders stopped lending. Many of them never came back. Many went out of business, and many came back in late March, early April with new guidelines, and they were no longer offering the kind of new originations that they once were earlier in the year. All of a sudden, we've started to see defaults increase, and we saw the credit lines that back a lot of mortgage originators come calling on those originators and telling them, you've got to move this bad paper off the books. So that market freeze, that liquidity freeze was not looking good in March, but something did happen. The US federal government stepped in. Congress initiated basically a blank check to Federal Reserve and Treasury, allowing them to print money and buy corporate bonds, corporate ETFs, and to flood the market, mortgage-backed securities market by purchasing billions of dollars of mortgage-backed securities. And that's really what's propped the market up this summer. That's why we see the stock market hitting record numbers yet again, because of this printed money that is flooding the market. The key to that is that there is a second aspect to government intervention. So that market liquidity providing by the federal government, the printing of money, the purchase of mortgage-backed securities, was one aspect of government intervention that we're going to discuss here today. The second aspect was foreclosure and eviction moratoriums. Many of you have seen this on the news and have experienced it in person. But the federal government and the state government stepped in and shut down evictions and foreclosures within their states. The federal government did this by way of the federal housing finance coming in and saying, if you have a government insured loan, a Fannie Mae, Freddie Mac, FHA loan, you have to listen to us and you cannot foreclose or evict borrowers. So that's the second aspect of what we're going to discuss today. At this point, I'd like to invite my two panelists, Kai Tsukiyama and Harris Howard, to turn on their videos and join the conversation. As a reminder, as we're going through our conversation and questions here today, please do enter your questions in the Q&A below, and we'd be glad to get into them. We have some pre-written questions that we're going to get into, and I'd like to start by introducing Kai Tsukiyama and Harris Howard. I'd like to give each of you a moment to say hello and tell us a little bit about yourself. Harris, why don't you start us off?
Great, thanks, Bill. Happy to be here with you and Kai. My name's Harris Howard. I'm the managing attorney of Howard Law Group, a full-service real estate law firm in South Florida. We handle everything real estate throughout the state of Florida, from loan origination closings to mortgage foreclosure litigation, both residential and commercial, both contested and uncontested, as well as creditor bankruptcy and evictions all throughout the state of Florida. Our team of attorneys provides competent legal advice coupled with great communication with all of our clients and direct access to an attorney for an update or strategy session. We work to resolve any loan that's in default as opposed to engage in unnecessary and protracted litigation that's costly and lengthy. We are not afraid to take a case to trial, though, if we have to. Since the pandemic started, we've been fortunate enough to maintain a consistent team at Howard Law Group, and in fact have added an attorney and a paralegal within the past 30 days, which I'm very proud of. And that's pretty much my brief summary.
Very nice. Kai.
Good morning, everyone. My name is Kai Tsukiyama. I've been in the real estate industry for the past 2 decades, focused on primarily the distressed market since the mid-2000s. Previously, I was with one of the large firms based out of Southern California that focused primarily on the distressed market. We were one of the large buyers, liquidity providers back in 2008 during the last downturn. I joined the Spurs Capital team in early 2012, where I've been involved in numerous trades and managing everything outside of New York, New Jersey, and Florida. Currently under management, I think we're to the tune of a little over 200 million with over $1 billion deployed since the last downturn. I mean, I can answer any other questions, but I think that's a brief overview.
Awesome, awesome. I want to get right into questions here. I have some that are planned because we're really looking to address what's going on currently in the with government interventions. I do want to point out, by the way, the reason I asked Harris Howard and Kai Tsukiyama to join me on today's panel is because these are two of the hardest working guys I know in my business, and they are on the front lines. They have seen what's going on the last 6 months. They've been doing this. They've been involved in secondary mortgage market, NPL mortgages for over a decade each. And so they are really the experts. So if you have a question, they're the guys to ask. I'm going to start with Harris, actually. Harris, if you wouldn't mind, why don't you start by giving us an overview of government intervention in the last 6 months? What does that look like from the perspective of you, a prosecuting litigant? The courts were shut down for a long time. I know certain states have reopened for certain cases. Tell us where things, what things look like over the summer and where things are now today.
Thanks. Well, first of all, thanks a lot for the kind words. I appreciate that, Bill. Always enjoy working with you and your team at Spurs. The past 6 months have been very interesting, obviously with the pandemic happening and the impact it's had on our industry in mortgage origination and mortgage foreclosure. In mid-March, when the pandemic started, the government, and I'm talking specific to Florida, the governor of Florida imposed some serious restrictions on our ability to start and finish foreclosure actions. And that was in place until the end of July. But during that 4 or 5 month period of limited ability to move or start and move foreclosure cases, and there was some nuance to each county and each judge, how they were handling it. There was certainly a stalemate in the ability to move files forward. And that resulted in us collectively with our servicer and investor clients working to engage in as much loss mitigation with the borrowers as possible, which led to a lot of productive resolutions. As Bill said, not every borrower is interested in that or able to achieve that. So some of the foreclosure litigation cases stalled until, as I said, in July of this year, the governor lifted many of the restrictions that were in place on the mortgage foreclosure litigation matters. And now we are able to, as long as the loan is single family and not federally insured, we are able to file new actions, proceed with moving those files towards foreclosure judgment and sale. And that has really opened up things for us. But during that period of time, there was a lot of delays and just unforeseen circumstances that impacted everybody.
Sure, and I think that every state has kind of approached it differently. I know that Florida extended it a few times. And then they still have, as it applies to COVID affected people, correct? But I guess the difficulty for those of us that were investors in this space, we're sitting there scratching our heads because we had files that were, defaults from 2 years ago, in many cases abandoned properties, and you're at foreclosure sale, and all of a sudden the moratorium comes in place, and it doesn't seem to make a lot of sense. We got the idea behind the moratorium and protecting people, given the uniqueness of the situation, but it was good that it seems like, at least in Florida, the governor has now made that differentiation.
So in Florida, there was very little. There was very little detail given in the moratorium in Florida, just that we weren't able to do things without any explanation or rhyme or reason as to vacant or abandoned or commercial. All of that was left up to interpretation, which made things a little bit more difficult for us as attorneys, and then for Bill and his team and all the other investors and servicers out there.
Well, and it's another interesting aspect of it. What it did do was it opened up some opportunities for us. We bought some packages, which I think you've seen some loans boarding in recent weeks for us, where literally those loans were at the finish line of a 9 or a 12-month foreclosure process. And then the sale date got canceled by a moratorium. So that lender, those lenders or investors, those, especially in the non-QM world, were really stuck in a situation where they had a timeline they were expecting to be able to liquidate and get this money back. And now with the unknown, they had to come to us in the secondary mortgage market and sell us these things at the even a bigger discount than we would have bought it as a new default 6 months earlier. So now we have loans sitting, waiting with final judgment, waiting for a sale date that we paid, 55 cents on the dollar for. I will get to some of the questions in a few minutes, but let me, what do you, just before I go on to a new question, Kai, you manage a lot of these NPLs in other parts of the country, and as it pertains to this moratorium, what are you seeing in different states? Is there a clear delineation from one state to another? Some of the experiences you've had in terms of what we're discussing in these moratoriums.
There's definitely a significant difference between the individual states. For instance, we've had multiple foreclosure sales that have already taken place in the past 60 days. There's some areas that are still very heavy on the moratorium and basically putting the brakes on any new actions or actions to get to the finish line. So there's a lot that's taking place, again, just on individual state level. I think one thing to point out is it makes a significant difference when you're looking at insured product. Insured product has historically traded at a much higher price point due to the fact that it is government insured. Now that's kind of turned because of the simple fact that a lot of the people that are currently holding those loans are looking for liquidity, and they're willing to let them go to a cheaper price than is historically valid because of the simple fact that now they can't do anything. Now with some of the moratoriums being pushed out now to December, it's very beneficial for us on the secondary market where we're getting deals. Deals we haven't seen at this price point since 2008, 2009. I mean, back then we were buying things at a relatively similar discount, but even today we're finding some discounts that are greater than they were back then.
That is interesting, and that was actually one of my questions. But I'll get to that a little bit later in terms of I want to hear your perspective on where we are compared to 12 years ago. But before we get into that, maybe you can just talk about market liquidity in general. My understanding is that the Fed and Treasury basically have blank checks. They've been buying mortgage-backed securities, and as well as government bond, as well as corporate bonds, and using these as a way to stabilize the financial markets. What are you seeing in terms of the effects on that, and do you expect this to continue?
Whether or not it can continue is something that's still out for debate. The major thing I've seen in the past 5 months is with the government buying mortgage-backed securities, we're finding a sense of comfort. Initially in March when everything kind of started taking place, you saw a pullback from lenders. Guidelines changed. They were very, very conservative. Now the government's coming in buying mortgage-backed securities. You're seeing a lot more comfort when it comes to new originations. The new originations being picked up by the government really helps, stabilize where the guidelines are sitting with individual lenders. But more importantly, what that's doing is it's driving the real estate market. So if you pay close attention to the real estate market, things aren't sitting on the market like they were even pre-COVID. We're seeing things fly off the market, and it's really counterintuitive, right? Today, most things it would seem that people would be pumping the brakes, sitting on the sidelines, waiting to see what happens. But things are selling at record times, right? We have properties that are selling under contract, multiple offers in 3 days with getting above ask. And it's not because we're pricing them low, it's because we're pricing them right, but it's just so many people in the market with not enough product. Rates are all-time low. All these things are beneficial for the real estate side of things. From the secondary market side, I think there's a big difference because now there's people that want to be able to originate new loans and take advantage of the government coming in and buying those mortgage-backed securities, which they can't do if everything is currently deployed, right? So they're finding a way to get liquidity by selling off loans on the secondary market and being able to originate new stuff. So
I'd like to add something. Thanks, Kai. We're seeing the same thing on the REO side in Florida. A lot of our investors and servicers have taken advantage of the seller's market, and our REO practice has been very busy with the dispositions of these properties due to the conditions that are currently in place, as Kai mentioned.
Hey, are you there?
Yep.
Sorry about that. I must have had a little technical difficulty. Zoom stock is obviously doing very well, but maybe their network is a little over flooded. You brought up a very good point with it seems like such a dysfunctional market right now because of the fact that you have so little inventory of real estate, and yet we have this building of market.
Seems like Bill's having some technical difficulties. Are you back, Bill?
I am back. Okay, sorry about that. Okay, you can hear me okay, right?
Can.
Yep, now we're good.
Okay, let's go on to our next question. The government insured loans moratorium just got extended a few days ago, Harris. And take us through what loans that applies to, what does that mean, and how long that lasts. Just give us a little update on that government insured moratorium.
Yep. So anything that's federally backed by the federal government has had the moratorium on foreclosures and evictions extended until the end of this year, which is a large portion of loans in the whole market. So it has a big impact on our industry. My book of business at my firm is mostly private investors that buy and sell NPLs like Spurs does, Bill and Kai. So there's little impact there to my practice. But some of the nuance of the federal moratorium is that it doesn't apply, obviously, to the private funds and servicers and investors that have non-federally backed mortgages. Commercial properties are exempt from that moratorium, as well as vacant and abandoned properties are excluded. The impact of that moratorium is certainly relevant to the private investors because I think it's going to lead to some transactions that Kai and Bill can speak to. But it's also, I think, going to open up the courts where, because those loans aren't part of our process in the foreclosure world, we're able to get our files moving. Hearings are generally pretty available. So we don't have any delays like we had in 08, 09, 2010, when there was a huge number of defaults and foreclosure filings. So, yeah.
But I would assume that the anticipation would be that once that January 1 rolls around, we're going to see a huge influx. Is that the expectation, that we'll go from 0 to tons of cases flooding the market? Or what are your thoughts on that? What are you hearing from other attorneys that you network with?
Yep, I think so. And I think we saw a little bit of that when the Florida governor's order was modified at the end of July, where there was and still is a lot of new filings that were sort of built up in the pipeline during the 4 or 5 month moratorium that we had. There's a slight difference with the federal loans because I don't think they're sort of building up the complaint preparation in their pipeline. The files are literally on hold. There's a lot of loss mitigation that's going on. In fact, I think the borrowers have the ability to request and achieve 12 months forbearance with some, based on meeting some certain factors. But there's a lot of loss mitigation on the federal loans that is mandatory, as opposed to some of the nuance that applies to the loss mitigation on the private side.
Right. And how is that affecting things, Kai, on your side in terms of both from the existing loans that you have, whether they be insured or uninsured, and how you're dealing with loss mitigation and whatnot during this moratorium time, and then even more importantly on the acquisition of new loans, given this situation?
And I think the moratorium has definitely had an effect on our industry as a whole. I find more and more borrowers are actually not really taking advantage of the situation. So, being around for the 2008, financial crisis, there was definitely a very, very big difference between the mindset of a borrower then and the mindset of a borrower today. We find that they're not taking advantage of the situation by just calling out for forbearances. Although, the forbearance rate across the country is significantly high in comparison to where it was prior to the pandemic. I anticipated a lot more people coming to market or coming to the servicers and raising their hand for forbearance issues. I mean, the majority of the issues that we've had or the files that are currently in default were actually in default prior to COVID. And although that moratorium does apply to them, we are not seeing a lot of people come to the servicer and say, I'm having an issue because of COVID. The majority of the people want to stay on track. And, the moratorium this time is very different, right? There were forbearances that were done back in 2007, 2008. But the difference between today and then is that the forbearances then, they were still had a negative effect on the credit. Whereas today, although it doesn't, we're not seeing as many people raise their hand, which is great for our market. From a pricing standpoint, we've definitely seen a huge difference in pricing, especially right around March and April. There was a significant discount that was given to people in the secondary market to purchase new, different assets that were put out in different pools. We're starting to see that stabilize, and I think you touched on it a little while ago. I anticipate a large influx of product coming down the pipe in Q4, in between Q4 and Q2 of next year. I think there's going to be a big amount of stuff that comes up market, and there's going to be a good opportunity for everybody to make some money.
I agree with that, and I'd like to add, I think some of the volume of defaults that we haven't necessarily seen that we're hearing about that Kai mentioned is soon to come is related to the increase in unemployment benefits and the PPP funds, which are still relevant to a lot of our borrowers on residential and commercial side. And as those funds diminish and expire, that's going to lead to less of an ability for the borrower to maintain their payment and then likely default, like you said, in Q4 and Q1 of next year.
One of the things that I've seen in my portfolio speaks to some of the inefficiencies in the mortgage servicing market. Servicers deal in much larger quantities of loans than we deal with. So even if we are, managing $100 million worth of investments, that might only be 400 or 500 loans that my entire company is overseeing at one given time, versus in the servicing world, you're talking in the billions, and you're talking asset managers that are each assigned 1,000 loans. And so one of the jobs that we do as investment managers, in addition to networking with our boots on the ground that are interfacing with the borrowers directly, is we're looking over the shoulder of our servicer. We're surveillancing their work. And, they go in and across the board have put foreclosure holds in place on portions of our portfolio, and they're not necessarily have the time to go through and separate the insured from the uninsured, and knowing the specific ways that each state is treating it. So we may have a loan that's a non-insured, not a government insured loan, which still the servicer is kind of lumping into that August 31st redemption, or in our case now that's been extended through the end of December, or like Harris said, if it's a vacant or abandoned home or a pre-COVID default that has nothing to do with the reason for today's moratorium, we can inform our servicer to lift the hold and move that file along. The reason I point this out is we're at the wheel looking at our portfolio and seeing this, and there's a lot of banks and a lot of investors in NPL who are managing forests and not trees, and so they're not able to. Those inefficiencies are what we take advantage of, and that's when that's why I think there'll be more opportunities for us. Going back to your modeling, Kai, I believe you had said in a previous conversation that since March, you've been backing your bids up on new NPL purchases quite a few points and still getting hit. Can you talk about that a little?
Yeah, I guess in comparison to the end of February or all of last year, we've included in our bid model a 120-day additional hold time, and we've also backed our bid up basically by about 12 points, and we're still getting hits. Things have actually come up a little bit since maybe May of this year, and we're probably back down by about 8 points. But it's still 8 points different from where we were at the beginning of this year. So it's definitely a big difference that we're seeing.
This is the second time you're through this cycle, Kai. You were at Condor in 2008. I met you back then in that summer. It was months before Lehman Brothers fell or AIG needed a bailout, I believe. It was really months before the financial crisis when NPLs were already starting to rack up across America, and your company was getting involved in the purchase of those for what people like to reference as pennies on the dollar, although it's never really pennies, right? It's more like dimes and nickels. Where do you see today compared to 12 years ago? Do we have another financial crisis? Do we have, is it going to look different this time around? What are your thoughts on that?
I think the landscape of the forbearance plans that are being offered is definitely different than it was then. Coming out of a default back in 2007, 2008, it was just a completely different beast. When you came out of it, you were required to come to the table with a full reinstatement or a very, very significant down payment in order to catch back up, and for you to be, I guess, reviewed for a possible modification. Today, with the moratoriums that are in place and kind of the landscape of our business, a borrower can come in and make a single payment and be reviewed for a modification to get themselves back on track. So in regards to whether or not there's going to be another financial crisis, I couldn't tell you with 100% certainty. What I can say is that from a default standpoint and a borrower coming out of default, it'll be significantly easier today for them to come back from that, which will prevent a foreclosure and further defaults down the road.
Yeah, that's very true. I'm going to just quickly reshare my screen for a second. You guys stay on here. I wanted to show the audience some of the August headlines that I like to always keep everybody up to date by the minute, and just give you a little background of where things are delinquency rate wise, because we haven't yet seen a lot of the fallout because of, as Harris mentioned, we had to kick the can down the road. We have PPP, we've got the extra unemployment benefits, and you're right, Kai, there hasn't been as many requests for forbearance as we expected. At its height, it's around 9 or 10% of government insured loans were in that 3-month forbearance program, and that has dropped somewhat in the last few months. But from what we're seeing here, as of the numbers of just last month, and we'll get into these numbers very empirically at our next webinar on September 15th. We're going to be fortunate enough to have as our guest and market analyst from Black Knight Services. Black Knight is one of the largest loan servicing and real estate and mortgage data solutions in the country. And we'll have some very up-to-date numbers, probably looking at where things are in August. But I wanted to show you guys some of these recent headlines and point out a couple of things. For instance, I did this Google search for CoreLogic, and if you look at the difference between December 10th of 2019, where the U.S. overall delinquency rate was the lowest it had ever been, to August 11th of this year, so about 9 months later, we are now at the highest level of overall delinquency that we've seen in almost a decade. And so think about this. You still have about 5% of mortgages that are in this forbearance program, even though the forbearances have in theory expired, and people are now asking for more help. Our default rate nationwide on residential mortgages was just under 3%. If half of the 9% of mortgages that were in forbearance this spring and summer, if only half of those come back and say, I can't continue, I can't get back on track, somehow the servicing isn't handled correctly, we've more than doubled the number of mortgages in default overnight. And then when you look at that compared to on this chart of the unemployment rate, which jumped from 4% to over 14% at the beginning of COVID, and has now only come back about 4 points in the 5 months since. That is a concerning number. And so we are certainly going to see a buildup of defaults. Unfortunately, a lot of people are not getting their jobs back, and therefore are not in a position to refinance or get approved for your typical bank standard modification. So I want everyone to keep that in mind as to where we stand in terms of perspective on the market. So,
Bill, can I jump in for a second on that?
Yeah, go ahead.
Yeah, I think that scenario creates a very positive possibility for investors like yourself and law firms like myself that are in the nuance of each file and have the ability to work out a mod or work out a deal with the borrower, which is really a win-win, as you explained in your book. But it's the truth. Giving the borrower, especially in these times, the ability to start fresh, whether it's with a mod or moving to a new property, is certainly easy for my office to accomplish when we have the backing of someone that's so hands-on like you and many of our other clients, which goes also to your earlier point of working very closely with your vendors, including your servicer and your attorney, to make sure that they're aware of all of the exit strategies that investor X has, whether it's commercial or residential, and make sure those are constantly and repeatedly explored.
Right. So just because there's a delay on foreclosures and moratorium on evictions doesn't mean that you can't take active steps to talk to your borrower. How does that feel, though? This is really for both of you to kind of give your perspectives. Does it feel like the fact that the government's tying your hands and saying you can't foreclose, so you no longer have that stick, that fear of a foreclosure or eviction that you are holding over a borrower as a way to get them to talk, how does that affect loss mitigation? And the attitudes of some of the borrowers or their counsels? Why don't you start with that, Harris? What are you seeing?
Sure. Well, again, most of my book of business is on the private side, so I can't say I've had a ton of experience engaging borrowers that have the leverage of knowing that their federally backed loan is somewhat unforeclosable at this point. Eventually that will expire, and those payments that become due are continuing to accrue for the most part, and that makes reinstatement and sometimes deals in 1, 2, 3, 5 years later more difficult. But on the private side, it hasn't had, I don't think, much of an impact, because during the 3 or 4 months, some of the investors weren't sure whether they wanted to even get going right away. And then once we were able to start foreclosure again, we did just that. And we are constantly, even in normal times, not only coronavirus times, trying to resolve cases at my office. So I don't think we've seen too much taking advantage of the situation from borrowers as you may think.
Understood. Kai, what are your thoughts on that from the loss mid perspective?
You know, from a contact standpoint and conversation standpoint, I guess on the insured side, we are still able to contact them, and the approach is different, right? It is, hey, how's it going? You know, what is it that we can do to help you out? And basically, you know, kind of forming an alliance with the borrower in order to get them on board to, you know, figure out what the best solution is for them. You know, in some instances, we find that, you know, for our non-insured product, you know, we still have our boots on the ground that go out and, you know, kind of see, you know, what the situation is, how, you know, we can get them back on track. Is there a payment that can be made? What's affordable? And even if there's something that is affordable that is way below our threshold, we can give them some type of forbearance plan to at least continue to make some type of payment, which helps offset any costs that we have from the servicing side.
Yeah, that makes sense. And one of the things that I foresee happening as a result of just the inefficiencies of mortgage servicing is that there's a lot of stuff that gets lost and a lot of borrowers that get left behind simply because, you know, we all owe some sort of debt, or most of us do in the world. You know, whenever we've had any kind of issue that we try to talk to a lender or debt collector, you don't get personalized attention. You know, anything outside the box is very difficult, and that's why loans go bad and stay bad. You know, one more question that I have, and we'll jump into audience questions after this. Let's say we're watching today, you know, the audience is out there agreeing with everything you're saying. There's a concern for government intervention and how that might affect the industry. There's obviously, you know, this seems like a lower risk investment, being that you're not only buying first lien mortgages, which are already usually at a level lower than the collateral that they attach to, but you're also then paying a discount there. Do you have each of you have any words of advice? If you're looking to refocus a career, you're an investor that's looking to get into this business, or you're just one of the many service providers and real estate involved people that is out there looking to get involved in this industry and the growing number of REOs. Talk to me, Kai, first. Do you have any words of advice on where people should be, any concerns they should have, any areas to look at, where are the opportunities, how do they get involved?
I mean, I think it's really important for a person coming into this industry to understand is that, you know, there's going to be tweaks that are made to your model throughout the entire process, right? And those tweaks come from experience, and, you know, basically teaming up with a group or a team that has experience, that has gone through multiple different cycles, is going to be key. You know, you can't learn this overnight, and, you know, there's a lot of stuff that you can learn, but it really is a trial and error thing. So, I mean, if they can find somebody that, you know, again, is a good teammate for them, that can get them the product at the right prices, at least the right price they believe are for today's market, I think that's going to be key. You know, and going into it knowing that there's work that goes into this, right? So it's not just I invest my money, I get, you know, 10% return on a monthly basis. It just isn't that way. But there are significant returns you can get through this product if you get with the right person.
Very cool. Harris?
Yep. I think is doing some diligence. If you're new to the space, doing some diligence and figuring out what you're actually buying and how that is going to look after you buy it and what it's going to cost to get there. You're not just buying real estate here, you're buying loans. And again, whether on commercial or residential side, you need to understand what that looks like, and having a team of experts to review your collateral, review your title, review your litigation is really important. And then to Kai's point, surrounding yourself with a good team to remain hands-on, not only with all of your vendors, servicer, and attorney, but also with the borrower to constantly engage with them to try and work out any defaults and make your paper reperforming, which is a net benefit to everybody.
That sounds great. That sounds great. Okay, well, I think it's time we should get to some audience questions. If we go a few minutes over, I don't have any issue with staying a little bit later. Let's go ahead and get to those. What is it here? I am going to start the first question, and then I'll ask Merrick, our MC from Opal, to join us and ask the next ones. Joe Levy asked a very good question early on here, and I wanted to make sure that got answered. What is the average gain after the VPO value? Is it the 40% or some discount? And the answer is it is some discount thereof. And then Kyle, you can get into some of the, confirm this for me. But my experience is, and when we say we're buying at 60, so that's an average number. If we have to take a property back through REO, we might spend another 5 or 10% to foreclose, pay off a borrower, and rehab a property. So our cost basis might be 65 or 70 by the time we own the real estate or control the real estate. And then if you sell something at 100% of value, you can expect maybe 8 to 10% in your closing costs. You have to pay marketing fees to brokers and closing costs, title insurance, etc. So usually that spread, while it could be a full 40%, there have been plenty of cases where I've seen a loan come in and then a few months later we get a full payoff because the borrower is able to refinance or sell the property. In many cases, that spread is more like 20 to 25%. I hope that answers your question. Kai, do you have an opinion on that?
No, I think you addressed it pretty well. I mean, again, like Bill mentioned, there's some instances where we have 100% return in a matter of 30 days. And there's others where it'll take us a year and a half, 2 years, and we still end up with a high teen, mid 20% return. So it really does depend on each individual loan and each individual borrower circumstances.
Okay, great. Wonderful. Merrick, you want to ask some of these questions?
Yeah, of course. So we got a couple of great questions from the audience, and I think we'll start from this one from Jose Reyna. It is, hello, Bill. So I guess it's directed towards you, but it says, what type of delays can a note buyer expect from defense attorneys once the moratoriums are lifted, in Florida in particular?
Oh, that's a great question. Okay. Defense attorneys is something we haven't got into, and I'm definitely going to redirect this one towards Harris, but I will say, I remember 10 years ago, in 2010, I no longer live in Florida. I'm based in Southern California myself. I just moved a few months ago, but I was in Florida for 18 years and did most of my NPL investments in that area. We used to drive down from, I would say from about 2010 to 2014. If you were driving I-95 up and down the eastern corridor of Florida, especially in major places like Dade, Broward, Palm Beach County, the majority of billboards on the side of the road were stop foreclosure defense attorneys. And so the question, I think where Jose is going on that is that industry coming back, and where, will there be all of a sudden a new group of defaulted borrowers that will be convinced by foreclosure defense attorneys, especially in judicial states like Florida, to kind of play the system. I think that could very well happen. Harris, what are your thoughts? What do you think?
Yeah, absolutely. Certainly with increased volume of foreclosures to come, there's going to be a lot more foreclosure defense attorneys that are delaying our cases and making us prove up our cases. It's also not the worst thing in the world. Sometimes a good opposing counsel will allow and foster a settlement. There's a cast of characters throughout the state of Florida that some of you may know that are impossible to deal with and only want to litigate. But those are, sort of the known players, and we deal with them accordingly. There's also a lot of nuance in your question in terms of what type of loan you own and when the default is, residential versus commercial, and default related to coronavirus or not. The governor's order that was from July that lifted some of the restrictions had a specific definition of when the limitations imposed, and the burden is on the borrower to prove that they've been adversely affected by COVID, and there's a few factors that the order lists that are relevant to that analysis. Since that is relatively new and none of the cases that I filed have coronavirus-related defaults, that hasn't really played out in court yet, but I think we will see some creative arguments from defense counsel to try and delay and raise the current circumstances as issues within the foreclosure case. I'm happy to get into some of the specifics of your specific portfolio or whatever note you're looking at. Whoever asked that question, I think it was Jose.
Yeah, that's great. I'm going to also be sharing each of our email addresses in a moment, and so you can feel free to reach out to us with specific questions. It'll both be here on the screen share and as we close, and also I'm going to be putting it in the chat below. Kai, do you have any thoughts on that question?
No, I think you guys addressed it well.
Yeah. Okay, next question.
Well, so we got this from Nathan Werner. Do you see the pricing on NPLs reverting to less than 50 cents on the dollar anytime soon?
Kai, you want to take that?
I don't think that's going to be at that unless there is a really, really large influx of product come, Q1, Q2 of next year. Again, we did see some pricing that we priced back to, in the 50s, and some even in the high 40s where we were receiving some accepted bids on. But at the end of the day, with everything going on, I'm not sure that we're going to see anything sub 50 consistently anytime soon.
And that the only exception to that being obviously the super low value assets, that trade for pennies, and in some cases we get for free, those sub 50 or sub $100,000 properties. We'll definitely see, like Kai said, a move into the 50s, but I don't know that we'll ever see sub 50 again. Next question, Merrick.
Of course. So this is a question from Dan Ragul. It says, for your situations, who do you prefer to have talk to a borrower who is delinquent, a lawyer, a servicer, an asset manager, someone else, or do you feel it depends on the state?
Very good question. Kai, you want to start with that? That question?
I mean, I guess for me, it would be one of our people that we have on the ground. And then the asset manager, not the servicer, but asset manager within our organization for us personally would be the person I would want to speak with them. Basically, what happens is we have a group of agents all throughout the country that will go out, door knock the property and get in front of them. Really kind of figure out what their intentions are with the property and see, again, how it is that we can assist them get back on track or help them find, a new place to live. So, and the answer to that question for me would be 100%. One of us or our network of people that we have on the ground speaking to the borrowers directly.
Right. And obviously Harris is, I'm going to speak for you, Harris. Obviously Harris will say, because he's an attorney representing us, his first obligation as a lawyer is to, if the borrower is represented by one, to only speak to that lawyer. Is that correct, Harris?
Yeah, well, not because I want to raid on your parade, but because there's federal regulations and state regulations that require it, and we don't want anyone to get sued. There's FDCPA and FCCPA in Florida that have some regulations on who and when we can speak to borrowers directly. And as Bill said, the sort of number one point is if the borrower has an attorney, there's some limitations on when the investor directly can speak to the borrower. So definitely be mindful of that. And I would add to what you guys said in terms of who can communicate with the borrower, presuming they're not represented by counsel. I think it should generally be someone that has decision-making authority and someone that's able to make a deal with that borrower right now and not wasting the opportunity of having direct communication and ability to make a deal. And from my office and my experience, we pride ourselves on actually doing that. So we have a great relationship direct to our investor clients, and we oftentimes have settlement authority given to us when the referral is received, and we sort of know what our client's looking for. The game has changed, and most investors want to modify loans. So we're able to get that in front of the borrower generally all of the time if someone's willing to engage with us, and more specifically on specific mod terms if we're able to get that from our client initially. So definitely taking advantage of someone with decision-making authority in front of the borrower.
Yeah, no, that is a very good point. And I agree with both of you. I agree with Kai in the sense that the servicer is probably our last choice of who we want to talk to the borrower, but we do obviously let them do their job. If they're able to get the borrower on the phone, it's their job to do so, and they'll try to. But we've all gotten calls from debt collectors. And so we know how that call always is a little different than just a personal human contact. They call you up, there's usually a delay because it's an auto dialer call. And then they read you the mini Miranda, which is anything you say will be held against you, basically. And it creates this antagonistic relationship with the borrower, which is really what we're looking to avoid. And going back to what you were saying, Harris was saying about the law and and us protecting ourselves. I'm proud to say that even though we're very aggressive about getting in touch with borrowers face to face and having conversations, we have an almost a perfect record when it comes to the CFPB. One of our servicers actually was so surprised because they really pushed back on the fact that we wanted to talk to borrowers or have real estate brokers, knock on doors, etc. And after and they were very concerned about it, FDCPA and et cetera. And we were the only client a few years ago that had yet to have a major CFPB complaint. Many of these borrowers and a lot of the CFPB complaints come or FDCPA issues come from the antagonism that borrowers feel as a result of the way these loss mitigation systems have been set up. So it's kind of the reverse. So I do feel it depends on the state. I do feel it depends on the specific case. Sometimes the best person to talk to somebody is a real estate broker we know that lives in the area of the borrower, that can go to that borrower and say, hey, we see there's a foreclosure in the public record, so they're not sharing any private information. Just so happens I have a relationship with your new servicer, or even better, I have a direct relationship with the investor in your loan, and we're here to tell you they're not Bank of America, and they're really somebody that wants to work with you. So in those cases, we would prefer to have those conversations directly with the borrower. And like you said, we're people in our private equity position that have the ability to make decisions. And that's really the key, because when anybody calls a servicer, they do not, those people don't have the ability to make decisions. Next question.
Of course. So the next question is again from Dan. I think it's definitely topical to the times. It is, how difficult has it been to collect from borrowers who are in nursing homes who have gone delinquent during COVID?
Good question. Nursing homes. Most of the borrowers that we're dealing with that are in nursing homes, we're usually dealing with an authorized third party. So it's a son or a daughter or some caretaker, power of attorney. So it's very difficult to get in touch, obviously, with the borrower directly in those circumstances. And so it's usually a third party that's handling the affairs of people at that point. While it can be difficult, it can also sometimes be good to have a third party be your intermediary in those situations, because you know that the end is near. So, you know, in many ways, and I'm not saying just life-wise, I'm saying that what's the point of carrying a mortgage on a property that you're not living in, right? I think we have one more question. We have time for, I know we've gone over. For those of you that are still around, I appreciate your attention. We hope that this has been fulfilling. Let's go ahead and ask this one last question. And then, and I'm gonna, while I do that, I'm gonna share my screen just so that we have some updates on the future. Go ahead and ask that last question.
Yes, of course. So this is from Matthew Kelly, and it says, as MBS has been referenced a few times in your discussion, can you please elaborate on the process in which a MBS registered with the SEC is broken up and eventually sold to private investors like yourself and those to whom you sell? If you could also explain the role of those involved in the process, including the MBS brokers, attorneys involved, and rating agencies downgrading the securities where they are eventually broken up and sold. That would be the last question from Mr. Matthew Kelly.
Sure, good question. Do you want me to take that, Kai, to start?
Go for it.
Okay, so mortgage-backed securities, the idea behind securities is that you bundle a pool of mortgages and then create these securities, these shares that can be sold off in much smaller numbers. And then those investors in those securities are taking advantage of owning a little piece of lots of mortgages. The idea behind mortgage-backed securities was to add obviously more investors to the pool of potential buyers in that world, and also to supposedly decrease the risk, because you had a larger pool of loans that you were drawing on. We don't buy the securities themselves. And because when you buy a security, you're only buying a piece of a mortgage. We're whole loan mortgage investors. That's what we do. So when I buy a loan, it's not subject to securities. We buy a loan that is the entire loan. And it takes a lot more buying power, obviously. If you want to buy 25 loans, you know, it could be $15 million, or it's a serious amount of money, and it's not necessarily something I can go out and leverage very easily. So it's an equity-rich business. The mortgage-backed securities aspect of the business is kind of like fuel that adds more investors to those that are in the mortgage world, whether it be CMBS, commercial-backed mortgage-backed securities, or residential mortgage-backed securities. So the idea being twofold: give access to smaller investors, a more liquid product that could be traded and sold easier, and where I could come in and theoretically with $5,000, I could own a piece of 1,000 mortgages. Needless to say, there was a huge industry that sprung up as a result of that. It got out of control in the middle 2000s because the rating agencies were in cahoots with the brokers and attorneys who were creating these packages of securities. And there was a lot of bad ratings given to, good ratings given to bad loans. And that's where the last financial crisis came from a real disparity between what the loans were and the quality of those loans that were inside those securities versus the true nature and the risk level of the loans. This time around, new issue mortgage-backed securities are a lot less risky. They're more institutional grade. I would hope that the attorneys, the brokers, and the rating agencies involved in that business have learned their lesson from the last go around, although I would not guarantee it. And so I hope that answers your question. Do you guys have any, Kai or Harris, have any other perspective on that?
Nope.
Okay, great.
Not really.
Well, I really appreciate you guys being here. Thank you so much. Remember, we've got another episode. The three of us will be back, plus some additional participants. Andy Walden from Black Knight Financial Services. We're also going to be bringing in a commercial real estate expert. One of my partners, Ari Melter, will be in the next event as well. And of course, these two gentlemen that are here today. Feel free to reach out to us directly. Merrick, thank you so much for inviting us to be here.
No, thank you. Thank you for joining us and being able to be a part of the Opal Group webinar series. But, again, like they said, please feel free to take down all their contact details, which you see up on your screen. And again, if you do want to receive a free copy of Win-Win Revolution, please visit the website, www.npncapital.com/book. But with that being said, again, Bill, Kai, and Harris Howard, thank you so much for being able to join us. Where we took a good look at the impact of the U.S. government intervention on mortgage servicing and real estate capital markets. And unfortunately, that is all the time we have for today. But again, please be sure to visit that website for the free copy of the book, as well as Spurs Capital's website at spurscapital.com. And please be sure to take down everyone's contact information. Feel free to follow up with them directly with any questions. Again, you will be able to find a copy of today's episode at opalgroup.net under the on-demand section. You'll also be able to get more information on the events, on our upcoming events, as well as the upcoming webinar, episode 2 in this series, which is finding safe opportunistic investments in times of turmoil, and where they will be taking a look at showing the rising defaults that create opportunity for distressed debt buyers. So please put that in your calendar. Listeners, thank you so much for joining us today, and we will look forward to having you with us at the next one. Thank you so much and have a great day.